Reviewing July, we had a relatively good month in equity markets again on the back of what's been a pretty strong 6-month period. Notwithstanding that, we've started August with a bit of a challenging period as we've started to see some results come through from the mega cap companies, which have spooked the market a little bit, and we've seen some volatility into the markets, both in the US, through Japan, and then through the rest of the world as markets have sort of started to digest what interest rate cuts are starting to mean, and the fact that economies are potentially slowing down, which is what the stimulus is trying to achieve with lower rates. So getting back to July specifically, we had markets up around 4% here domestically. Mixed bag as you start to go down the market cap spectrum. So the bigger companies performed better than the smaller companies. The expectation there was that inflation was still relatively high. The RBA was being talked about as to increasing the interest rates here in Australia, which is different to policies that are being set overseas. And that sort of put a bit of a shock through the smaller and mid-cap companies that are more impacted by some of those interest rate increases. From a reporting season perspective, we're really at the tip of that for Australia. We've seen some of those reports come through in the US, and the focus has largely been in the mega 7 or the mega cap 7 companies. And some of those have underwhelmed with both the numbers and also their outlook statements, which has led to quite a significant pullback in some of those companies. That's why you need diversification in your portfolios and making sure that you're not invested in specific sectors or specific companies too heavily. So reporting season here, we're at the tip of that. So we'll start to see companies report more heavily through August. It does get quite busy and does generally lead to a little bit of volatility in company specifics as companies start to present their information, and markets start to try to understand, well, what is the impact of the current environment and what's the outlook for these businesses based on what the companies are saying. The thing about companies and sectors specifically, so the banks here have performed relatively well. They've had very strong economic conditions. While things are starting to slow, that's probably a bit of a concern for those banks, given how expensive they seem to be in the market. So that's something to look out for, and they don't generally report in this part of the reporting season. They're on a different calendar cycle. But there's still potentially some announcements that come through from other companies that will give a bit of a guide for banks specifically. Resources are challenged with lower commodity prices and slowing demand through China. Both those sectors, the resources and the financials, are significant components of the market here in Australia. So that might lead to a bit of a challenging sort of outlook for the economy and for markets more specifically. So that's something to keep in mind. When it comes to consumer-related sectors with interest rates that are restrictive in the RBA's terms, it's going to be interesting to see what those companies suggest is happening with the consumers. So whether people are truly spending less than what they were previously, and what the first couple of months of trading has been like for some of those companies. So that's going to be really interesting to watch, and that's probably where some of the greater volatility will be in the markets, as those that are performing well will have relatively positive outlooks, and you'll see some that will be challenged by the consumers that are starting to spend less and be more cautious with where they're investing or spending their money. So fixed interest for July was relatively benign. So domestically, the focus is still on inflation, and the talk through the month was that we may see higher interest rates because inflation here has been stickier, and the RBA's on about a 3 to 6 month lag compared with other economies where we raised rates or started raising rates later than other economies. So we're starting to see cuts from a cash rate perspective through Europe and also through Canada as well. The US is the one that everyone's waiting and holding their breath about as to how and when they start to cut. There's a lot of talk and a lot of noise in the market that they need to cut, and cut quite aggressively. That'll be something I think that'll become more evident through September, so there's probably likely to be a bit more volatility as market participants and market players start to try and guess what and how much of a rate cut will happen in the US. It's likely to lead to a bit more volatility, as we have been talking about. So clearly there's noise related to the election, the candidates that are now elected and nominated. There's still a lot of uncertainty around who will control different parts of the government structure over there, which markets don't like uncertainty, and that is typically where the volatility does kick in a bit more. And so, people will be analysing policies, bigger picture. The election's likely to have a bit of an impact in terms of market volatility, but longer term, you've still got bigger themes and bigger picture things that you need to be focused on, and that's where we'll be focusing, is to understand. Well, let's remove some of the noise that's happening in the election and try to focus on what the bigger picture, longer term thematics are, what some of the bigger longer term policies may be, and what impact that may have. So the cash rate expectations are still in a bit of flux. So I think the betting markets, if you want to focus on those, are still probably having a bit of a bet both ways. So the RBA's announced that they're on hold for August. So that's good news for mortgage holders and good news for businesses that rely on a bit of credit to fund their businesses. So that's a positive. They're still very focused on inflation, as we know. And the latest statement that they've released with the announcement is very much focused on that, and very quite sternly worded around the fact that they will continue to focus on ensuring that inflation is sustainably lower than what it is at the moment. So I don't see that there's a cut anytime soon. Some people are suggesting that you're probably not likely to see anything until early part of 2025, which again probably lines up with how much of a lag we've had for our rates to increase versus other global economies, and how the economy is performing here. Immediately, we are going through a bout of volatility, which I don't see dissipating while we've got a few of these headwinds in ahead of us. Clearly the election will be an element that, as we've said, adds some volatility to markets. And you've got a policy change. So central bank policy change is a change of expectations around what the environment is for the economy. So it's normally not a good sign when rates are being cut, that they're cutting because they need to stimulate, or they're cutting because rates are too high and they're contractionary. And so that there comes into adding a bit of volatility around expectations and around what people are thinking is going to happen next with economies and with companies and markets. So I think that's, yes, it's a little unnerving once you do start to see a higher degree of volatility, a higher level. But if we focus on personal objectives, if we focus on the long term, and if we've got diversified portfolios, you've got a lot more confidence around being able to ride through what are normal market cycles and normal market volatility conditions.